Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex financial world so you don't have to. We're diving into the latest filing from Cohen and Steers International Realty Fund, and let me tell you, it's a juicy one packed with numbers and strategies that shape global real estate investments. Before we jump in, if you appreciate these deep dives into corporate filings, make sure you're subscribed and hit that notification bell. Also, for direct access to our community and exclusive discussions, join our Discord server linked below this video. So what are we looking at today? It's a semi-annual shareholder report, a snapshot of how the fund performed from January to June of 2025. Think of it as a checkup for a massive international real estate portfolio. They break down performance by different share classes, Class A, Class C, Class I, and Class Z. Each class has different fees and ways of investing, which affects the final return for investors. For instance, Class A shares have a 4.5 head sales charge, which is like paying a fee up front when you buy in. Let's talk money for a hypothetical $10,000 investment in Class A. Shares the cost for the last 6 months were just $73. That's about 1.35% annualized. Not too bad considering the global market is a complex beast. Now, for the performance itself, the Class A shares saw a total return of 18.76%. That's pretty solid. But here's the kicker, it slightly underperformed its benchmarks. The UPSI ex-US index, which returned 19.49%, and the MSCI index, which returned 19.49%, and the MSCI index, which returned 19.49%. And the MSCI EF index, which returned 19.49%, and the MSCI index, which returned 19.45%. It's a small difference, but in the investment world, every basis point counts. The report explains this by highlighting strong stock selection in Australia, particularly, and overweight in Charter Hall Group. This real estate manager did well because of falling interest rates and more activity in Australia. They also benefited from not investing in NextDC, a data center owner that had a flat return due to what they call uncertainty about near-term customer demand. On the flip side, an underweight in Switzerland hurt their relative performance. Switzerland's market was strong because it's seen as safe during uncertain times, but the fund didn't have as much in it as it could have. Similarly, stock selection in Sweden and the UK also dragged down returns. It's a constant dance of picking the right companies in the right countries. Looking at the historical growth of a $10,000 investment over the years, we see a pattern. Class A shares have generally grown, although with ups and downs. For example, comparing the June $38 to the June 30, 2025 figure of already $3-4 shows a significant jump in the last year alone. But notice how much more that same $10,000 invested in the MSCI index grew to $18.7088. That's a big difference in something invested in the MSCI index. Grew to $18.7088 index, grew to $18.7088 dollars in the 1830 2024 figure of $10,088 index. Grew to 1878 AF index, grew to $80.7088. The fund's average annual returns tell a more nuanced story for the 10 years ending June 30, 2025 Class A. Shares without the sales charge returned 2.17%. That's modest. Compare that to the MSCI FAF index, which returned a much healthier 6.51% over the same decade. This suggests that while the fund has grown, it hasn't kept pace with its major international benchmarks in the long run. Let's look at some key stats for the fund as of June 30, 2025 net. Assets are around $261.9 million. They hold 66 portfolio positions and their portfolio turnover rate is 35%. A turnover rate indicates how often the fund buys and sells its holdings. A 35% turnover isn't excessively high, suggesting a moderately active management approach rather than rapid trading. Now for the meat and potatoes, the top holdings. Goodman Group is their biggest bet at 7.7%, followed by Mitsui Fudosan at 5% and Vonovia C at 4.1%. These are major international real estate players. Goodman, for example, is a big logistics and industrial property owner. Mitsui Fudosan is a Japanese giant involved in office retail and residential. Vonovia is a German residential real estate company. Knowing these top holdings gives you a sense of where the fund is placing its biggest bets. Sector-wise, the fund is heavily diversified with 53% in diversified real estate. Industrials and retail hold significant portions too at 11.4% and 10.9% respectively. Residential makes up 10.7%. This diversification across sectors helps spread risk. Geographically, Japan leads at 24.5% of the portfolio, followed by Australia at 17.1% and the United Kingdom at 10%. Hong Kong and Singapore also feature prominently. This global focus is key to the fund's strategy. Let's peek at the operations statement. For the first 6 months of 2025, the fund generated about $5.1 million in investment income, mostly from dividends. After paying out expenses, which include advisory fees, shareholder servicing, and administrative costs, the net investment income was around $3.8 million. But that's just income. The real story is in the gains. The fund recorded a net realized gain of roughly $4.6 million on investments. Even more impressive is the unrealized gain, which is money made on paper from investments still held. They saw a change in unrealized appreciation of over $34 million. That's a huge boost to their net assets, bringing the total increase from operations to over $42 million for the 6-month period. Looking at the statement of changes in net assets, the fund's operations contributed positively to its overall value. However, when we look at capital stock transactions, the net decrease in net assets from share transactions was over $6 million for Class A shares. The decrease was even larger, over $4.8 million, further highlighting investor activity. Now, let's drill into the financial highlights per share, which are crucial for understanding the actual value an investor holds. For Class A shares, the net asset value per share started the period at $7.82 and ended at $9.14. That's a respectable jump. Their total return for Class A shares in this period was 18.76%, as noted earlier. But notice that same metric for 2022, a negative 24.07%. This shows the volatility inherent in international real estate investing. A good 6 months doesn't erase the possibility of significant downturns. The expense ratio for Class A shares after reductions is 1.35%. This means for every $100 invested, about $1.35 goes towards managing the fund. This is important because high fees can eat into returns over time. Lastly, let's touch on their privacy policy. They clearly state they collect information for everyday business purposes like processing transactions and also for marketing purposes. But importantly, they say they do not share personal information with affiliates or non-affiliates for marketing. This is a good sign for customer privacy. Overall, Cohen & Steers International Realty Fund shows solid performance in the first half of 2025, particularly in its stock selection in Australia and France. However, the fund's long-term returns have lagged behind its international benchmarks in key periods like the last 5 and 10 years. This underperformance, coupled with significant redemptions in some share classes like Class I, raises questions about investor confidence or perhaps a strategic shift. The global real estate market is inherently volatile, as shown by the significant negative returns in 2022. While the fund appears diversified, its reliance on major international players means it's heavily influenced by global economic trends, currency fluctuations, and interest rate changes. The fees, while not exorbitant, are a consistent drag on returns, so investors need to be comfortable with the long-term growth prospects, not just the short-term gains. What do you think about Cohen & Steers International Realty Fund's performance and its long-term outlook? Do those returns justify the risk and fees? Let me know your thoughts in the comments below. If you found this deep dive informative, give this video a thumbs up and subscribe for more unfiltered financial analysis. And for direct engagement with our community and to get your questions answered, join our Discord server linked in the description. Thanks for tuning in to Corporate Decoder. See you next time.